Hello and welcome to the first ever episode of the Self-Wealth Real Estate Podcast with your host, Luc Boiron. Today, I wanted to interview a friend of mine, Christian Szpilfogel. The reason I wanted to interview him is because there's a lot of training in the real estate industry that is more focused on mindset, which is important, but less focused on the fundamentals of real estate, how to do it professionally, ethically, and in a sophisticated manner. That's what Christian brings to the table. So Christian is an experienced investor. He's invested in a variety of different real estate assets, from multifamily to light industrial, commercial, office, and he's done it in a very systematic, professional manner. So I thought today we'd have him on, share his story about how he got to where he is, and something that's going to be a feature of the show going forwards is our deal focus segment. And that's where we're going to talk about the worst deal and the best deal, and that this person's ever done, that our guest has ever done, and we're going to talk about what they learned, what lessons they learned from those deals, because I have always learned best from case studies and from real life examples. So that's what I want to bring to you on this podcast. Story of how the person got to where they are, but also real examples, what lessons they learned, so that you can take something away from every one of these podcasts. So without further ado, I'm going to bring in my special guest for today, and thank you so much for joining us. Welcome to the first episode of the Self-Wealth Podcast. I'm here with my first ever guest, Christian Szpilfogel. Did I get that right, Christian?
You got it spot on, Luke. Well done.
Perfect. So I'm going to let Christian introduce himself, but for me, Christian is both a friend and a mentor. He's someone I turn to when I have questions about multifamily properties, and he's someone that I respect greatly because anyone can be a real estate investor. And it's really wonderful to have people like Christian who are who focus on the fundamentals, who really understand evaluating properties, managing well. And it's not just about getting excited and going buying properties. He actually analyzes things properly and does a really good job of it. And so I've always really admired Christian for that. And I'm really happy to have you on as my first guest, Christian.
Well, thanks. I'm kind of blushing now, right? It's not just the lighting, especially coming from you you're a very successful entrepreneur, so it means a lot to me. Thank you, Luke.
Well, thank you, Christian. So tell us about yourself and how you got to where you are.
Boy, there's a long story there, I suppose. The reality is that we were a single income family. I worked for a private corporation and I didn't have a pension. So I needed another way of ensuring our future, if you will, post-retirement. So that's kind of how the thinking started. And my wife was very much interested in doing real estate anyway. So for the two of us, we just naturally gravitated to that. And then I think it really sealed the deal when I talked to an older gentleman. He was in his probably early 80s at the time, retired school teacher, and he had always done real estate investing. And I asked him, I said, "So Bob, why did you do real estate investing?" And he said, "Well, I've done a lot of types of investing over the past, but real estate was always the best returns and the easiest way to build wealth." So I took that to heart. And interestingly enough, my wife and we bought our first property from Bob. So it was right next door to our house. So that's how we got started. And we had some other dabbles that we did before that, but the very first property we bought was 2005. And it was a purpose-built 4-unit building literally right next to our house. And I actually, as we're talking, I can see it out my window.
Do you still own it today?
Yeah, I do. Yeah, it's a great building. It was purpose-built. It was built by an engineer, we believe in the mid-1940s. So he needed a place for his mother to live. And so he built this purpose-built building. It's literally concrete, right? So it's brick veneer, but it's concrete structure. Even the heating system is really super cool. So it's a boiler system, but it actually delivers heat to each individual unit, and each unit has its own blower assembly, right, to blow heat in, and it's then ducted within each of the units. So very, very comfortable. And it overlooks the canal here in Ottawa. as well in one of the NCC tulip beds. So as you can imagine, it is never difficult to rent out.
And that sounds like
very
a pretty.
low maintenance.
That sounds like a property you want to keep forever. So I understand keeping that one.
Oh, definitely. It's it's definitely that kind. It's my worst performing asset in the big scheme of things. But purely because there isn't a lot of upside. It was exactly what it was supposed to be when we bought it, and very little room to find other creative ways of expanding the NOI on it. But it's a solid asset and it's not even a distraction of our time.
Okay. And you were in, I believe, a tech career before you got into real estate. Is that right?
Yeah.
What were you doing?
So my background, and this will probably explain why my math is pretty good. So my background was actually in university. I did physics. And then I went into a career in technology. So ended up in the telecom sector, working on really super cool stuff. And then I basically went up in levels within the tech industry, where I eventually finished so I was the chief architect for a while, and then I became a general manager of a couple of business units. And then in the chief architect role, I was involved a lot in mergers and acquisitions of other corporate assets. So all of that experience, so whether, the basic math that I understand from physics, the math that I learned from finance people within the organization, the concepts of mergers and acquisitions and how those are structured and how it works, really helped prepare me for doing some really cool things in real estate. And that's where, when I take a look at any new opportunity, I look at it from a business lens. So for me, it's not just about acquiring an asset. I'm trying to figure out, okay, what's the business objective here? How am I going to make money? What's the cash flow projection? Because I have a business to run. So how do all those things come together? And I have a way, a lens, I will, of any acquisition and what the plan is around that. So that it's a funny segue, but that's kind of my background. And I left. I was just going to say, just to wrap it up, is I left the tech business about 2017. And at that time, our real estate assets had grown to such a level that it was impossible to manage both careers at the same time. So we transitioned at that time.
And you found the real estate career was more, at least financially, rewarding.
Oh, I'll tell you, Luc, and I'd say this to my ex-tech friends, right? Or they're actually still my friends, but ex-tech. But but I tell my friends there, I say, there's a lot easier ways to make money than tech. Right. And most people think, the glory life of doing startups and technology firms, it is hard work, right? Like it's a lot of hours, and you're fundamentally working for someone else in most cases. And as I say to them, I said, there are easier ways to make money at it. And real estate has been really very good for us, for sure.
Well, and you hear stories that I think push people to kind of stay in tech about the unicorn startups where they get ownership or options, right? Shares of or employee stock options in these tech startups with the hopes that it becomes a unicorn. But as an employee, you don't have that much control over that particular company becoming a unicorn. And selling at a crazy high valuation where you're suddenly a multimillionaire many times over just from your employee stock options. The reality is, it's more often than not, it's not going to be a success. So, but you hear about, it's like hearing about lottery winners. It makes you want to buy a lottery ticket.
Well, that's right. And you can, it's evident in the very definition of a unicorn. It's extremely rare. So now, not every corporation or every tech firm becomes a unicorn, but they all have sort of natural exits. And in the end, people who work in those firms, especially if they start very early in the business, they have a real possibility of making some decent coin. Okay, so I don't want to, poo-poo it at all, right? It's, technology. If you're into tech, and I definitely I'm still into tech, to be fair. But if you're into tech, it's as much a passion as it is a job or a career. And so it's, and the opportunity to make money is actually there. Generally, the engineers are reasonably well compensated. In startups, most of it is in the promise of futures, as you said, with stock options or restricted stock units. But there's some promise there. And, I still live vicariously through tech entrepreneurs. I do some angel funding in that space. And I set realistic expectations. I always put in money with the expectation that I probably will never see it again. And I do get involved sometimes with their boards to help direct them. But if I do get a return, it's usually at least 10 years out, right? The companies may have merged with other companies along the way, but it's usually about 10 years. And some of them don't pay out ever, right? You basically get out less money than you put in. But I've had a few cases where the returns have been, really quite good, like 10x or 100x of what I originally put in. So it can work out. But here's the thing. In that, if you listen carefully to the words I said, it sounds much more like speculative investing, right? And I never expect to make a return. With real estate, it is a very deterministic outcome. And I like deterministic business cases. I like to know that I start here, I finish here, I'm going to make this much money. And yes, there are risks, but you can manage those risks. And so the variability in the outcome is not nearly as substantial as you would in a lot of other businesses. So that's another great reason that real estate is a solid way to invest, right? And the key is invest, not speculate.
Well, and I wanted to go back a little bit where you were talking about how your tech career kind of gave you some skills that you were able to, that were transferable into the real estate industry. Because I was, as you know, I have a company that markets and buys and sells hundreds of houses a year across Canada. And I have one of my best friends, since we finished our undergrad business school, he's been working in M&A for one of the largest tech companies in Canada. He doesn't work there anymore, but he worked there several years. And, he was manager there, and he was involved in buying small software companies around the world. Then he ran he ran their Asia division for a while as well. But he was trying to buy small tech companies across Asia, and they operate them out for the income. And it was just interesting the way his business is set up, or his job was set up there, where they're marketing, filtering leads. Just the process of trying to buy these different companies is so similar to the way that my business tries to buy houses. And even though they're completely in different industries, there are such transferable skills or practices and processes to operating a business.
Yeah, there absolutely is. Now, when you're in the non-real estate world, I'm trying to figure out if it translates exactly, but it would be, oh, maybe it does. So it'd be build, borrow, or buy is the words that we would use. So certainly in the tech sector, you're either building the technology, you're borrowing, meaning that you're licensing it from someone else, or you are buying it, meaning that you're doing an acquisition, right? So you're building that technology. I suppose in the real estate world, that's kind of transferable. So I suppose you're either building the building, right? You are leasing the building or property or land, or you are, which is a form of arbitrage, right? Or you are, buying the building, which is the acquisition piece of it. So we often tend to fixate on in real estate, it's always about the acquisition, but it is such a diverse industry. There's so many ways to make money in the real estate world. It's not just about buying things. I mean, you could lease things and do some form of arbitrage, or you could layer on and maybe buy an asset that's sitting on top of a leased asset, right? So it's really some potentially interesting analogies for sure, but they are transferable skill sets. There's no doubt.
Yeah. And the leasing, the Airbnb arbitrage is pretty popular nowadays. Even agreements for sale are kind of a combination where you kind of have control of the property until closing before title transfers, but it might be many years. There's a kind of combination approaches too. I've never done an agreement for sale. I've never really seen them done in Ontario, but I don't know if you have. Have you seen agreements for sale done in Ontario?
They're legal in Ontario, although some lawyers don't, would suggest to you they aren't, right? Just because of their nature, right? But things like agreements for sale, etc., assignments, etc. These are all just tools in the business. And that's what a lot of people forget. They think of them as strategies, and I don't really view it as strategies. They're part of your problem-solving tool set. In order to get any good deal, as you know, Luc, because you're really very good at this, the key to doing a successful acquisition as part of a successful business case is actually solving, in our cases, typically the seller's problem and sometimes the buyer's problem. But it's all about problem solving. And the differentiation that anybody can have in this business is being a better problem solver than the next guy, right? So... and an AFS is just another tool in the toolbox.
Absolutely. We structure a lot of creative deals. I just bought a house in Carleton Place, and I believe you own some property in Carleton Place as well. But I just bought a house in Carleton Place over the weekend, and it was on MLS, and I was trying to get the price much lower, and I was working the deal for something like 2 months. Every other week, I was in touch with the seller through the realtors. And what ended up working was, I believe they thought the property was worth much more flipped or fixed up than I thought it was worth. So what I offered them was, I'd like it at this lower price, but I would give you a share of what it sells for above a certain price. So in this particular case, they were asking originally $350, then they lowered to $299. I ended up buying it for $230. And I'm going to give them 25% of whatever it sells for above $350,000. So they get a share of the upside. In a way, it's exciting for them because they become involved in the flip in a way. But it's not, it's pretty clear what it sells for. This is, you're going to see the number on the MLS. It's pretty clear what it sells for. So it's not, I don't particularly like saying, I'll give you a share of the profit, because that's harder to calculate. But the nice thing about this type of deal, structuring it this way, is one, if they believe it's worth more fixed up than I do, then they're going to potentially think they're going to get more. And if they're right, they're going to get way more on the back end. But if it's lower than I was expecting, or both of us were expecting, then it actually reduces my risk because my break-even point is now lower. So yeah, that's just a fun little deal I just did over the weekend.
It's funny because you're spot on, and I love that nature of creativity, right? Because it really puts a pin in... or a great example of how you can structure a deal that's a win-win. Funny enough, I have two examples in Carleton Place that are a little bit different, but kind of illustrate the same kind of thing. So one was, and I'm going to go with this one first because it's probably near and dear to your heart in terms of the way it could be structured. I kind of jokingly refer to it as a reverse wholesale. So I had this property that I figured you'd get a chuckle out of that. So what happened was I had a 10-unit building, and right next to it there was this rundown triplex. It was a disaster. I'll just, I could go into well, I'll give you an example. Okay, so one of the units, the fellow had lived there all of his life. He, basically grew up there because his mother rented the place before he did. And he'd lived there until he eventually passed away, I think at the age of about 80 or 85, somewhere around there. I never knew the gentleman. I just knew well him. And so when we went in to take a look at the unit, if somebody's been living there for 80 plus years, right, you can imagine what it might have looked like. And this fellow was a heavy smoker. So, what color the walls turn with smokers.
Right? Yeah, until the nicotine starts running down the lines.
Well, there is that. So it's typically the walls become yellow, right? Sometimes you start to get the running stains, etc. But if you've been sitting in one place and the cigarette smoke is there perpetually for decades, do you know what color the walls turn then?
I imagine some form of orange or brown.
Oh, very, very close. It turns red. So the spot where he used to smoke all the time in the kitchen above, right, was a red stain. We thought somebody had been murdered in the kitchen. It's like, that was our first impression. So this, it gives you an idea. This building was a little rough around the edges. So what we were worried about at the time, this was more of a, it's a triplex. So it was a relatively small asset for us. It wasn't really in our normal scope of things, but it was right next to a building that we did care about. So we didn't want someone to pick it up and just continue it as a rundown thing because it would affect our property value. So I said, you know what, let's just pick it up, clean it up, be part of improving this part of the neighborhood. So I wanted to buy it. When I talked to the lady who owned it, she was on the fence about whether to sell or not. And I just asked her, I said, okay, what do you think it's probably worth? And she was in the realm, I think she wanted 225. I figured I could easily get her down to 180, right? But there was a risk it might have to settle at 200. And even though I can play it cool, I was a motivated buyer because I really didn't want this place to go into the wrong hands. So what I did instead in that scenario is there was a local fellow who was highly credible. And I just called him up because he's a builder and investor as well, and he's known within the community. And what I said to him was, look, I think I could probably get this for 180, but if you can get it for a better price, I'm going to split the difference with you. Right? Okay. And he ended up doing it he said, are you okay with an all cash offer? And I said, yeah, that's fine. So he went in and he ended up getting it for 167, right? So, and I'd said anything below 180, right, we'll split the difference. So for 2-3 hours work on his side, max, including all the paperwork, he earned about $6,500 on that. And the win for me, of course, is I got it for the equivalent of 173.5. And I ended up putting about 150 into that, I think. Something like that, maybe 125, but it was about 3 to 325 all in, reappraised at 500. So small numbers, I know, but the beauty there in that one is that all the money I put in came right back out, which is what you like in any good business case. And the other was the creative approach of trying to find another way to get a deal done, right? Which kind of, mirrors the situation that you had, but a slightly different way.
Yeah, no, I love it. The story of the person having been there 80 years made me think their rent was probably, $65 a month or something, $300 or something super low, which also gives them no incentive to kind of upgrade the unit at all. So it must have been very original. But also that story makes me think I have a couple of my multifamily properties where we're trying to turn over units and there's a couple problem tenants. And I don't think the management companies I have are the best ones to negotiate kind of a cash for keys to get those. There's one in particular. Great building. We have several units turning over, but we just have one really, really bad tenant who's letting a lot of kind of criminals move into the building and things like that. So we're waiting on a court date, but it takes forever. And it's the holdup to turn over the whole building, get it refied, all of it. It's just one unit. And I've thought about trying to find somebody else other than the management company to kind of send in to I need to find someone who can, who's very good at negotiating with tenants in terms of finding a way to have them leave. So kind of like you had someone negotiate with her.
Yeah, well, usually what you're going to do in tenant scenarios is it's like any other form of negotiation. So you have to have some form of leverage, okay? And sometimes the tenant has leverage, against the landlord because maybe who you acquired from didn't do a very good job. So the first thing you have to do is to get rid of that leverage by showing that you're a different owner, right? And that you run things differently, and so you diffuse that leverage. But if I'll always say, good tenants, I will leave them alone. I'll help them. I will I'll be the best person for them. We'll be their best friends. Honestly, it's, we have a very ethical approach, as you know, Luc, about how we manage tenants. But if there's a tenant who is, interfering and becoming really problematic to other tenants, the key around that is to put them on the back foot, right? So that's where something like in Ontario an N5 would work, etc. So that way you're in a better position to negotiate a cash for keys situation. I'm always hesitant to talk about this kind of stuff only because we usually have active negotiations,
Yes.
on the go, right?
We'll tell you a little bit about what's going on with this tenant.
Sure.
So I think we have served them N5s. We are renovating the building, and their unit needs quite a bit of work. So we have an N13 out, and we're waiting on a hearing date. But just a little bit of background on this tenant. So other tenants' cars were getting broken in because the tenant basically has this is a 12-unit building closer to Toronto. The tenant basically has friends who would otherwise be considered homeless, with long rap sheets, living with him, kind of couch surfing. So it's a 2-bedroom unit that's full of people, and none of them have a clean criminal record, let's say. So the other tenants' cars were getting broken into. When we bought the building, the front door didn't have a lock on it, so we put a lock on it, and all of the tenants got keys. And then we had a special lockbox for the mailman to go in. And that lockbox was broken into by someone who was living in that unit as well, even though the tenant got a key. It was broken into and the key was stolen. And then we set up security cameras, and we were able to catch the what they call it, the task force, basically the SWAT raid of one of the units, because someone else living in the unit, when they kicked down the door, someone else living in the unit who was not a tenant, had been stealing cars in the area. So we just see like a line of a dozen police officers coming in, breaking down the door. The police dogs are there, the K9 unit. It just, there was, when we bought this building, it's in a good area of the town, but this is the building where, the drugs were, the prostitution was happening, apparently in the laundry room. So it's a great solid building in a good area. And this is the last lingering bad. We still have plenty of other tenants who were good tenants in the building and were just, mortified but didn't have anywhere else to go. But this is the last really bad tenant who's bringing really all of the problems to the building. So we're working on moving him along because we want to keep the other tenants happy. And when we re-rent nicely renovated units for the ones that are vacant, we want to have people who want to move in, have a safe place to go, have somewhere nice to call home, right? So Interesting situation.
Well, it is, right? And at the end of the day, we have a responsibility to all tenants. And if a particular tenant is interfering with the reasonable or quiet enjoyment of other tenants in the building, as landlords, we're obligated to do something about it. And so what you're doing is perfectly sensible because clearly the other tenants are not feeling safe by any stretch of the measure. It's probably resulting in vacancies, I would guess, because who the heck would want to live in a building where they're at risk? So you do have a duty to fix that, right? And it's not like, if someone has a criminal record, but they're well behaved, okay, that's one thing. Okay. So it's not about the criminal record. It's about the active behavior right now. And that's the problem. Now, I've had these buildings and so, I've never placed a tenant that's become like this, but I've bought buildings where we inherit the tenants, and I'm certain that's the situation that you're in. And the one thing that I'm sure of, because I know you're very savvy at this stuff, is distressed assets like this usually come with a really good price reduction to compensate for the fact that you've got a lot of hard work to get it all fixed. But that being said, the returns on that kind of situation are usually very good, because once you have it fixed, the value of that particular asset goes up substantially. And so it can be a cornerstone to generating a really good profit overall. So a lot of people just get overwhelmed by the complexity of a problem like that. And they're just motivated sellers in that situation. And then if you've got the intestinal fortitude to take on those specific situations as opposed to the pure renovation situations, then they can be very lucrative, for sure.
Yeah, and you talked about it earlier about problem solving. That's how that's one of the greatest ways to succeed in real estate.
Oh, for sure. I'll give you an example. I've had a bunch of assets here, so I could tell you all kinds of stories that would mirror what you're going through. But one of my personal favorites, I think, was a building that we bought a long time ago now, and it was just a triplex. We converted to a sixplex. It was quite a few years ago. And in that building, what our intention was to do completely back to the bricks renovation. But in the meantime, we had, two reasonable tenants, and we had two really bad tenants. And you go, wait a second, didn't you say it was a triplex? Well, it was a triplex with an illegal unit as well. So it's just a little extra fun. So in one of the illegal units, they were drug addicts, right? And, if you know my history, so I have a lot of sympathy to people with addictions and mental health issues. But that being said, right, these people were really troubled, right, as well. Say, when we were doing the demolition, our construction guys had to have thick, heavy gloves on because there were needles that you just find all over the place. And then one of the other problematic tenants, turns out they were part of the criminal element in the area, in the sense that they would break into construction sites and steal stuff in that particular area. And they were reasonably well known. And just like your building is in a nice neighborhood, so was this building. So needless to say, we had N13. We were doing it with a reason one, because it was effectively a demolition, right, in that scenario. So there was no recourse, no need for tenants to be able to come back in. And it was because we were basically taking it back to the bricks and relaying it out. But the fun part, there were two good outcomes of this scenario. One is it's a good neighborhood. So when we were going to do the minor variances, and we had 12 variances to do on this property to accomplish our objective, but we had no problem signing up support from the neighbors in terms of what we were planning to do, because they were just relieved that someone was dealing with this finally, because it was just a terrible problem in the hood. So then, so that was one thing. So our committee of adjustments was less than 5 minutes, no objections, etc. Lots of letters of support. So that made it easy. But here's where the funny story comes in, is here we had just literally, it was all framed. We were finally putting in all the rough in. So the electrical, the plumbing, etc. So all this brand new electrical was in there, and we had a break-in. But tech, right? So I had wireless cameras that were centrally monitored at that time. We got an alarm that went off at about, I think it was 2:30 or 3 a.m. Immediately called the police. Police were on site within 4 or 5 minutes, because this is in Centertown, Ottawa. So it was literally less than 5 minutes from the local, police establishment. So the police were there on site. By the time I got on site, the first officer that I said, she said, well, there were two people in the building, and one of them is here, right? And she said, I said, I have a funny feeling I know who this is, right? And given the story I just told you, you know who it is as well. So the first guy was saying, I'll just keep it to first names. So I said, well, I don't recognize him because it was cold and he had his hoodie on and everything. And I said, are you John? And he said, no, I'm not John, right? And so then the officer closed the door. And but then his curiosity, and I was just talking to the officer, and his curiosity kept getting the better of him. He kept saying, he said, why are you looking for John? Why do you want John? Right? And I was just ignoring him. Finally, he says, I'm Billy. John's over there. John's my brother. So I just looked at the officer. The officer looked back at me. And I said, well, I'm gonna go see John. So I see John, who's already in cuffs with the officers, and he said, oh, Christian, I'm so glad to see you. He said, can you tell these fine officers that I was just here checking my mail, right? And I said, John, we have you guys on recording, right? We saw what you were doing. And his face just went like this. And of course, the officers knew exactly who these people were. They just finally caught them in the act. So for all the other stuff. But we were lucky because what they were doing, they came in with snippers. They were planning to cut all the copper out of the building in order to be able to sell it for scrap. Mm-hmm. And unfortunately, they got distracted by the big spools that we had left in there. So instead, what they were doing was loading up with the spools in their duffel bag, and they were occupied by taking that out. So by the time the cops arrived, they didn't have a chance to get in to cut the copper, which would have cost us tens of thousands of dollars to replace.
$300 of copper, of scrap copper, right? It's crazy how little they get compared to how much damage they can do. Yeah.
It is. And it's funny, their mindset is completely different. They just view that going to jail is just part of the cost of doing business. So it's not a very rational discussion with them at all. But, it's one of those things, and I'll spare you the stories of some of the other ones, but they're kind of along the same lines in one shape or another. But you know what? These are situations that if you clean them up, you can make money. And trust me, there are easier ways to make money than that, right? But it does add for some entertainment, without a doubt.
Yeah, yeah. Well, and being able to take care of it is what gives you the ability to get into the properties and the deals that can make the most money. But actually, the construction site, it actually reminded me a lot of that. Recently, there was that explosion in Orleans at one of the construction sites. And from my understanding, someone was in there stealing on-demand water heaters, and I guess didn't turn off the gas lines to them. But that person was well known to the police for having a history of similar robbing construction sites. So interesting. And I've had a couple sites broken into over the years. One of them I know was an inside job. Someone who had worked on the site let somebody they knew in the HVAC industry in, and they stole a furnace and an on-demand water heater that were just installed, and probably gave someone the fell off the back of the truck discount, right, to install it somewhere else. But so yeah, we try to use wireless cameras as well when we can, wireless modems for that. We don't always set it up, especially on quicker jobs, but we do try. Which is something...
Well, they're easy to do, right? So, the basic recipe. So for any of your listeners, the basic recipe is you get some wireless cameras, like an Arlo camera or Wise camera. They go back to a wireless base station. It then has a link to an LTE modem. So that's basically a data modem that uses the mobile network. So there's no risk of getting cables cut. And then you just hide it somewhere, right? So that it's not at all obvious. And the nice thing about those wireless cameras, especially the Arlo ones, they have a magnetic back. So we can literally just move them around wherever we need. If we can find a little piece of metal somewhere, it might be an electrical box, or it might be some of the framing on the drywall, whatever it is, you just stick it there, right? And move it around as your construction moves. So it's well worth it. And because they're remote controlled, right? So I have access to it. My foreman has access to the controls. So even if it was an inside job, the challenge they would have is being able to disable the alarm, right? Or be clever enough to know how to avoid the cameras, which in most cases would be very, very difficult. But I've found them to be an essential tool. And the other thing that you're pointing out there, right, with that natural gas situation, the guy almost certainly just cut the line and let the natural gas leak all over the place. And then now we understand. And personally, when I first started doing construction and major rehab work, I did not understand why construction insurance was so bloody expensive, right? It is really expensive. And now I know the insurance companies are justified.
Yes. Yeah. And I mean, there's just so much more, obviously things like that gas line, but even someone being there and a small fire breaks out, if someone's there, they can take out a fire extinguisher, they throw some water on it, they can call the fire department, they can stop it, right? If just there's a spark, you smell fire and you call someone and it gets stopped. But if nobody's in the house, then, they're not finding out about it until the house is really up there in flames and the neighbors are calling 911, right? Same thing with water, right? One of the flips we're working on now was vacant for a couple of years and the previous owner hadn't shut off water. The neighbors told us they called the city to shut off the water because the water was coming out of the basement windows. So water just ran until the drain plugged of, things falling in the drain, and then just filled the whole basement. which is amazing that it's in such good condition after we stripped it down to the concrete block walls. It's amazing that the block's in as good condition as it is for what it went through. So.
And was that a 3/4 inch water line, Luc?
I've never been in that house. It's in Durham region.
It probably, if it was a house, it was probably 3/4 inch, right? Possibly half, but probably 3/4. So at least you had that. If you're looking at some of the bigger buildings, then we had a scenario not dissimilar to that, but we were lucky because we didn't have the hooked into the water main yet. They were after the copper pipe, and we had a 2-inch line. So you can imagine how much water is flowing in, right?
One of the cost of that, like if it's metered, the cost of that, because we had at one house that was
just see. So you still had the meter.
No, in my case, this was before I owned it that it flooded, but we had another one where it flooded, and it wasn't even not nearly as bad, but it was $2,000 of water that was used.
Yeah, in the scenario that I had that I was describing, those lines we had literally just put in, so the city had not come back in to put the meter in yet. But on a 2-inch line, if we had it metered, it would have been an ugly, ugly bill.
And the city doesn't give you a break for pipe bursts, or at least City of Ottawa didn't give us a break. We're like, nope, you used the water. So, awesome. You know what, Christian? Another time we're gonna move to the next section. Another time I'm gonna want to have you on talking about operations and how you operate more efficiently, because I think that's one of your many strengths, but something that many real estate investors don't do well. Before we go to the next section, I wanted to ask you a little bit about, because we got so wrapped up in all the different questions I had, but tell me a little bit about kind of just high-level overview about where your portfolio is now, or why should people listen to you?
They really shouldn't, actually. So at the end of the day, I really view it as a business. Okay. And if you're looking at any business, you have to think about how you're going to cash flow in the business. It's really very simple. So whenever I take a look at an acquisition, it's always and people who know me always hear me say this, it either cash flows on acquisition or I line of sight to cash flow. And what I mean by line of sight to cash flow is I'm going to do some transformation of the asset through a business case that's going to yield growth in equity, and it's going to end up with cash flow coming out the other side. So when you have that methodology, because at the end of the day, just like the business that you own, cash is what you pay your employees with, right? You might write them electronically, but it's cash, it's money. You can't write them on promises of the future. And what I see some people do is they try to fund their operations out of future equity or refinances, etc. And I don't take that approach at all. So it's very much about the cash flow that we pay our employees with is legitimate cash flow coming out of the business. All the equity that we that we have and that we generate goes back into other acquisitions. So that's really kind of the base of how we run everything. And then that makes the business very scalable. So any particular renovation, we'll run that on the balance sheet so that we don't draw that from income from operations. So if I'm doing a repositioning project or a reconstruction project, all of the expense that's there that sits on the balance sheet till we do a refinance event, and then we pull that equity back out, it's re-amortized on a loan, and then the resulting cash flow goes into our cash flow for operations to pay our employees. So we do have that separation, and I do have I can certainly provide a link for your listeners, Luc. There was a podcast, or not a podcast, but a session I did with one of our colleagues back last May that literally went through business case examples on this. So we can add that as a link for people so they can see exactly what I'm talking about.
Yeah, that'd be awesome to get that. We'll put it in the show notes.
Yeah, for sure. And so the nice thing about doing it the way that I do is that you always have steady income regardless of what's going on, and you always have to manage the cash. It's really what it comes down to. So over time, we've acquired a variety of different types of assets. You know my portfolio structure in general, at least in the asset classes that we've been in. We've got a lot of multifamily residential, mostly in the 5+ space. I'd say most of them are in the maybe 10 to 20 range, somewhere around there. We don't have any of the really large ones at this stage. We've got some commercial space. Some of the first acquisitions I did were, once I went pro, if you will, was light industrial. And light industrial at the time was great because they just cash flowed mountains of cash. They didn't appreciate very much, but they generated lots of cash. I got lucky over the pandemic because everything went to distribution. And so light industrial became highly sought after and the cap rates came down very quickly. So I got some appreciation out of that, but it was never part of my original business case. I just say that was luck. The original part of that was creating more cash flows for the business is really what it was all about. And then we've, as I said, multifamily, we've got a little bit of retail, we've got some mixed use projects, and you and I actually, it's a funny story for your listener. You and I competed on one. I didn't know it was you, right? I'm not sure you knew it was me.
Neither of us did, and you won. So congrats, good job.
Oh,
and a beautiful, beautiful couple buildings. Yeah.
It was there were absolutely gorgeous buildings on a beautiful historic main street. I'm a sucker for that kind of stuff, Luke. I'll just tell you, I'm an absolute sucker for those things.
Do you watch all the Christmas movies now to see where they're filmed, to see your buildings?
I don't, but all my friends do, right? And they send me screenshots.
Nice.
Yeah.
Is that's everything?
So I don't know if that kind of answered.
Yeah, it does. It does. So you've got a mix, bunch of multifamily, some commercial space, some mixed use, residential and commercial, and then some light industrial. And I guess that commercial space includes office that you have as well.
Yeah, and office, as you can imagine, through the pandemic was challenging. So, where there were well-entrenched leases, it was fine. But over a 2-year period, you're going to get some rotational leases, and we did lose some office tenants in that time frame. This gets to another really important point in the investment world in terms of problem solving is just because an asset has been performing well in a certain configuration for a period of time, things change. So you can say, woe is me. You can pray for it all to come back to normal, or you can just roll with it and say, okay, things are different, still need money coming in. So you pivot and you change the use of what that particular asset is doing. So we on that one with the office space, this is an interesting case study because what we did there is we ended up shifting to micro offices in that particular case because the first of the leased ones was with a client. It's a government organization and I don't want to get too specific because there's some confidentiality in it.
For sure.
But they had individual offices already cut up in there. So all we do is we said, well, why don't we rent the individual offices out? We were, thinking because we were starting to get some inquiries, but we were thinking that what was really happening was people were forced to work from home, but they needed to get away from the kids, the dog, all the noise and distraction that they had. So they were willing to pay for a small private office away from their home that was nearby. So that's what we ended up doing, against better judgment. We've been told in the past that model didn't really work in that area, but through the pandemic, it worked really well. So we ended up leasing everything up completely. And we even converted some other space into individual offices because we had such a demand for it. And you'd say, okay, well, that's great from a revenue recovery perspective, but it did better than that because the smaller the space you typically lease, the more revenue per square foot you actually end up getting. So our revenue per square foot in those areas, they went up by 50%. So we converted what was a problem into a real win into that. But you don't know necessarily. I mean, you know, as much as we'd like to say we did research and market study, quite frankly, we had to react fairly quickly. And we had clauses within the leases that if things didn't work out and we needed to lease it out again to somebody else, we always have an option to buy out those leases and relocate people, et cetera, et cetera. So we had other escape hatches in there, or escape clauses, if you will. But the key is to do something, right? And not leave an asset to languish and to pivot based on market conditions.
Well, I think it keeps coming back to solving problems, right? Having that skill, that's the most useful skill you can have, really, is the ability to solve problems. Same thing as, you know, as you were saying, you don't know for sure that it's going to work, but there's a certain amount of your experience kind of gives you an instinct. And so you can have almost an educated guess on how it's going to turn out. And same thing with, you know, just my first Airbnb. We didn't know for sure what the numbers were going to be in that area. It was different than the other product there, but you know, we were able to get in at a very low price and make it really nice. And I mean, it's blown any projections we could have made out of the water. We didn't know how well it would do. Everything told me it was going to do well, and it did better than expected. So there's a little bit, you're not just completely guessing, shooting randomly, you know, in the dark, hoping to hit something. You have an idea of what you're going for, and you're able to make an educated guess that way. So yeah, that's awesome. And the light industrial is something I'm envious of. I've always wanted to get into light industrial. My father was a commercial real estate agent and did a lot of light industrial. And he bought a large light industrial building in 1980 in Toronto that my family still owns today. And that I'd like to get into something like that, similar, one day. But with, like you said, cap rates have gone down so much. I'm looking at stuff and this doesn't make sense right now for me to buy in. So
no, but it would make sense to build. It would make sense to build, though, Luc. So the cost of putting up a light industrial building is cheaper than acquiring them. You know, and if we go back to sort of the buy, borrow, build concept, right? Sometimes it's cheaper to buy, right? Sometimes it's cheaper to build. And for light industrial right now, because the cap rates are relatively compressed, you know, to put them up is relatively inexpensive because you're really just building a slab, you're putting some service in, you're building a shell, and then your tenants do all the fit ups inside the individual unit. So it's not like an apartment building where you have to outfit it with stainless and granite countertops and beautiful LVP floors. No, it's a concrete slab and a shell. That's it.
Yeah, absolutely. Yeah. Yeah, and your point on the higher rent per square foot for the office space, just going back to that as well. I like that. It's something I've considered too. For example, you know, recently we built a couple coach houses, or we finished one and we're building another in Ottawa. Some people call them granny flats, garden suites in different cities. And my philosophy is that it's worth spending less to build smaller ones, because the amount you're going to get in rent just for a unit to exist is the proportionate amount you're going to save on the build costs is higher than the difference in rent, right? So, you know, the last one we built it at 420 square feet, junior, one bedroom. I think we're going to be able to rent it for about 1,800-ish, 1,1800 plus hydro, which is also the heat source. So, yeah, I think there's, you know, and same thing, you know, we converted one building from 12 to 17 units, and I know you do similar things. You've got some kind of conversions like you were talking about, dividing up these units into smaller units, because if someone might pay 12 to 1,600 for a bachelor in a certain city, but then the one bedrooms might be significantly more space, but then they're only a few $100s more. So is that extra cost of building or using that space for that purpose, is it worth it? So you can kind of get better returns sometimes on smaller units. Not always.
You can, and you have to match that with the market demand. So, you know, as you were talking about earlier, we need to do the key market research to understand who our target customers are and whether or not we're addressing the right market. So, in downtown Ottawa, for example, there's a lot of demand for more affordable units, if you will, right? So bachelors and one bedrooms. And one bedrooms, if you can take a large bachelor and convert it into a one bedroom, you're going to get a price premium just because of that. But the demand for 3-bedroom apartments, as much as the city and the neighborhoods would like us to build more 3-bedroom apartments, the demand for them is very low in the city. And the only people that we found that really want 3 and 4-bedroom units are students that are all moving in together. So, and student housing is a whole other asset category in itself. It's a legitimate one, but it's another category. So what we find is, even though the neighborhoods would rather us build 2s and 3s, right, the demand is for 1s and bachelors, right? So, further emphasizing your point there.
Yeah. So at this point, we are going to go into our deal segment of the show, because I think we learn the most. I've always learned the most from examples of other people's properties. So what I'd like to start with, Christian, is can you tell me about the worst deal you've ever done, the worst property that you've ever purchased, or your worst experience with the property that you've ever had?
The worst experience? Probably, I would say that the one that I mentioned earlier, right, that had the problematic tenants, the one that it was, a legal triplex we were converting to a sixplex. And not because of the tenants. We kind of anticipated that. But that was our first, we'd done some smaller repositioning stuff before that, but that was our first serious reconstruction project. And to be fair, to the level that we went on that building, it would be the same as if we were doing new construction. And we made all the classic mistakes. We underestimated how much money we were going to put in. We underestimated in how rough a shape the building structure was, which is probably one of the reasons we went into over budget. We had situations where when we were gutting things, and remember, we did this properly. So we had the engineers looking at this, and, we were being very careful as we went through this building. But the building was, about over 100 years old. It was a stone foundation. And what we found as we really kind of opened the walls is, sometime, I think the previous owner had been there most of her life, but she, if a joist was in the way for something, she would just have it cut, right? Which isn't really good for structural integrity. No. But we had situations where we were excavating. So what we did in that one was we lowered the floor. We brought it down, and we did careful engineering there. We didn't need to do any underpinning, but we went down. We had enough clearance with respect to the footings to drop the floor down the way we want it. But nevertheless, we still had the back third, the foundation of the back third of the building collapsed on us completely. So, we had the building there. Unfortunately, because of the engineering, we had structural supports. We were a little nervous about it. But we hadn't planned on the fact that, we were going to be replacing a good chunk of the foundation. Yeah. So that one was challenging, and it was challenging too, because this was at a point where it was, first of one of those major reconstruction things. I had literally just left my job the year before. I was trying to establish my business at this point to be a cash flow business. So I was in the middle of restructuring all kinds of things, and I didn't necessarily have all of the cash on hand that I needed to deal with some of those overruns. So, I was starting to get real nervous when some days I was writing $50,000 worth of checks, and you do this a few days in a row, right? And, sweat starts coming down off your brow, and you're starting to think, okay, where am I going to get more cash if we really run this over far, far more than I do? And remember, we're self-capitalized, so it's not like I could do a cash call to investors, right? It was all on us, and I had to figure it out. So, there was some sleepless nights through that project. I learned a lot through it. Now I de-risk construction projects a lot, right? And you probably saw that I just announced some refinances that I just completed recently. And a lot of that, part of the rationale behind that is literally just to front end deleverage some projects. So I'll still do the construction loans in order to do what I need to do. but I've already deleveraged the project by having lots of capital on hand. I just don't, I like to now be in a position where I have more capital than I need than less. So that was a lesson learned out of that whole thing. Now, the good news out of that.
But you have that when you have the capital, you don't sweat the same way, right?
Well, that's it. You get lots of cash, and you still have to be tight about your money, right? So you don't want to, sometimes the temptation is when you have all kinds of extra capital is you start spending a little too freely. But so you still have to have a bit of control there. But that project in the end, we were, managing our costs extremely well. We weren't doing silly things. We were still, where it needed. We were putting more money in to get things done properly. But what ended up happening in the end is that the money that we put in, we were able to fully recover on the refinance. Some of that was, even though we ran the business case, it was relatively conservative. So some of that was the business case. Some of it was just, honestly, it was just a good tailwind from the economy that allowed us to get a slightly better valuation. So that ended up de-risking us. So, not every economy is that way. Sometimes it's not a tailwind. Sometimes it's a headwind, like it would be right now. But you do have to plan for all those things. But that was probably, every project has its story. But if you really want to get down to it, that was the one that I lost sleep about.
Well, and I like covering the worst deals because those are the ones we typically learn the most from. So yeah, you mentioned how you learned, from that experience, you're now approach construction projects from a better cash position because that gives you more comfort. Was there any other big lessons from that one?
I'd say, yeah, I think so. So the other thing that I learned was not as a result of consequence, but by asking good questions of other people, is since that one was going in with 12 minor variances, right, to the Committee of Adjustments, I was concerned about that because even if you put forward one or two, as you know, there's always a risk that somebody in the neighborhood doesn't like the project and will object on all kinds of crazy grounds. And with 12 going in, I was a bit nervous about that. So I'd learned a lesson, not necessarily on that project, but on a previous project where I talked to one of the city planners who I'd gotten to know a bit. And I said, look, I'm a bit nervous about these variances. And he said, okay. At the time, he was a planner that had done his rotation through the Committee of Adjustment. So he said, what you need to understand is the committee is a political body. In a small town, it's usually council. But in a large city like Ottawa or Toronto, it's a delegated authority from council, but it's still effectively a political appointment. So what you need to consider is that when you're asking for a variance, you want to de-risk that decision for the committee, because what they don't want is a decision coming back on them, because now it starts to make them look bad from a political perspective. So we learned from that, and what the lesson that we learned and what we did in that particular case, and I mentioned it earlier, is we shopped the project to the neighbors. We basically explained to them what we were doing, how it was going to happen, what the profile of the tenants would look like, what the building was going to look like. And we got their buy-in. And if they had some concerns, we addressed the concerns. If, in that case, actually, they didn't have any recommendations, but if they said, well, we'd like to see a bit more of this, we would probably take that into consideration as well to get buy-in from the neighbors. But what we did is not just go door to door, but I had them sign a sheet of paper that said they support what we're doing. So with my Committee of Adjustments application, I submitted, I think it was about 16 letters of support. And my thinking around that was, even if I have someone who comes in and objects, right, I can turn and say, look, there's always going to be one or two in the neighborhood that doesn't like it. But as you can see, members of the committee, the vast majority of the people in the neighborhood, all the closest neighbors, are in support of the project. So it de-risks them.
Well, that's excellent. I had the opposite experience with the Committee of Adjustment in the city of Ottawa. I didn't need any minor variances, but severing a lot that was allowed, the size was allowed as of right. So I was going just for consent application, Committee of Adjustment. And even though we tried, the neighbors hated us because the previous owners had been a biker gang. And this is in a suburban neighborhood, in a subdivision. So they were not fans. And apparently this biker gang would change the oil of their bikes in the backyard and things like that. And the neighbors came out in force against it, even though, us and the planner we hired tried, talking to them. We ended up at committee 4 times, finally got it approved, conditional on getting soil samples of the backyard to ensure it wasn't contaminated from bikers changing their oil in the backyard. Which is ridiculous because what we were severing was one townhouse off of an end unit townhouse that was on a 2.5 times wider lot than it needed to be. So we were just severing an extra lot off the end to build one more townhouse on the end, and people were not happy about it. So you did a good job getting the neighbors on board. We had trouble. We had trouble with that. So
yeah, it's not always seamless, right? But it's I take the view that it's a democratic society, and rather than imposing my will on the neighborhood, right? I'm not saying that was your case, because I'm certain it wasn't. But I see some developers that go in and it's like a force of will that they're saying, we want this project, and to hell with the neighbors. I don't care if they like it or not. And I don't view it that way, particularly when we're asking for variances. So in that case, what's always good is to work with the neighborhood so that you're fundamentally enhancing the neighborhood. And if you're doing something that the neighbors will benefit from, they're going to generally support you. And the process that you do that in order to make sure that the people that are supporting you are well represented, because let's be honest, if you go to the Committee of Adjustments, the only people who are going to show up besides you are the people who object, right? The people who support you, they have no motivation to go, none. So that's why you have to ensure that there's some level of representation for the people who support you to help balance that out. Because I'll tell you, like, you're lucky you just got to go back to the Committee of Adjustments to get it done, because if they make a decision that overturns your application, now you're going up to the provincial tribunal, right, in order to get it heard. And actually, it starts to get really expensive.
In our case, with the Bill 23 that came out, because it was just after that happened that we got the approval, it was not subject to being appealed. They removed the appeal ability for this type of application. Not exactly sure the details, but I guess the consent with no minor variances, there was no ability to appeal that. So that was good. So we had it for sure. And of course, for us,
at least we got it done.
Yeah, well, for us, we accepted the condition on the soil sample because we actually had it done before, because we knew they were going to ask for it. So we just did it. So we knew we just wanted to make sure we were no issue, to make sure we could accept the condition. And so it was clean. We accepted the condition, and then we could show the city that we had, we met the condition.
Well, and when we're dealing with commercial properties, including 5+ residentials, a phase 1 environmental is almost always required anyways, especially if you eventually get CMHC insurance, etc. And so as a matter of practice, we always do at least a phase 1 on a property. And even on the smaller properties, I think it's really smart to get that perspective, because conditions for lenders are continuing to tighten. So right now, a 4 or less property may not require a phase 1 environmental, or even if you're doing conventional financing on some of the other commercial stuff, you may only have to do an environmental questionnaire. But it's always in our best interest. It's only about $2,500 to do a phase 1 environmental anyway. Gives you peace of mind, gives you something to rely on. And if a lender eventually says, you know what, we think that all investment class properties should have an environmental assessment, you're not going to have to worry about, the fact that maybe there is actually oil issues in the back that have penetrated down another 3 feet, and now you've got an excavation effort to worry about. So, there's peace of mind in knowing this information. So you were smart to do that anyway.
Absolutely. Okay, awesome. Well, all right. So I love hearing about the worst deals, even though I don't love that they're the worst deals, but I love hearing the lessons from them, because that's the best way to learn. But can you tell us about what you'd say the best deal you've ever done is?
Yeah. Okay. There's a lot to choose from on that front, just by the nature of the business cases. But I would say, yeah, one of my favorites is a property in Carlton Place again. So this was a 6 residential with 1 commercial unit. And you're a very frequent buyer, so you'll understand the psychology in this one. The seller had overpriced the property by a long shot. And so we went in, we put an offer in that was, a deep discount to what he had, but still, in hindsight, well above what I was prepared to pay. So, and I looked at it in reflection while we were still in the conditional period. I go like, no. I'm just being over enthusiastic. This doesn't make any sense. So, I got out of the deal. I didn't move forward on that one, which is rare for me. Usually when I commit, I've done my analysis and I'm come hell or high water, it's going to happen. So, and I think that's important to be a credible investor, right? Like, agents don't really want to deal with people who are backing out all the time. So for me, though, it was one of those sober second thoughts and saying, no, this isn't right. This deal's not right. I don't care what I've put into this. It's not right. So because it was overpriced, nobody else was really coming to him. So I kept the lines of communication open with the seller. It sounds very similar to a story you were relaying earlier in this discussion. And in that one, I went back to basics and I did my underwriting properly. And, I'll give you real numbers. So this fellow was trying to sell this property for about, it was 1.3 million at the time, I think is where he started out originally. And I eventually, with my own underwriting based on the actual NOI for that property, I'd had it assessed at probably at about 780 or 790. So when I kept the communication going, and we'd had discussions, on and off discussions about this for quite a long time. I think about 7 months in, I said, look, let me come over to your place. Let's run through the numbers line by line so we can see if we can come to some agreement on this. And so we did that, and we literally went through the revenue for this unit is this, the revenue for that unit is that, etc. This is the expense. You've got all that. Okay, great. And so we came up with an NOI, and I said to the fellow, I said, what do you think the cap rate is for a building like this on this area? And he said, oh, I have no idea. And I said, would you think it's probably about 6.5, 7? And he said, yeah, that sounds about right. So I said, okay, well, let's take the more aggressive one, 6.5, right? And we ran the number through, and it generated a value of 790, right? The math is really straightforward, as you know. So he was like, oh, I can't sell it for that. He said, I've got almost $1 million into this thing already, because he had just renovated it in 2015, like completely beautifully done. Elevator in the building, everything. So it was, he said, I just can't do that. And then he came back about a month later with an unsolicited offer back to me saying that he was willing to sell it for $820. And I said, well, it's really only worth $790 to me, but I'll be okay to do it for $800 if we can close the deal now. And in the meantime, somebody just inquired about the building saying, oh, is this still for sale? So now he thought there's competition, right? And I'd been advised this guy was not always very rational. So now he said, no, he countered back at $850. And at the time that I'd gotten the 800, I'd gotten him to agree to a vendor take back, 90% vendor take back on this thing with at a rate of about 6% interest only. So then he said no. He said it's $850 now, right? And I said okay. And so I brought his former agent back in, and he's a local realtor, and I said, is he fixated on the price? And he said, absolutely. And I said, okay, tell you what, we'll do the $850. I want him to throw in the lot next door for that price. And I'd like to take the vendor take back from 6% interest down to 4.5% interest, right? But I'll give him his $850. He said, He said, this guy lends money all day long at 12%. He's not going to give you, a VTV at 4.5. I said, just ask. So he called him up and he said, he said he's going to sell it to you for 850 and he's got no problem with the 4.5% interest rate. And he is going to throw that land in at the same time. And I said, okay. I said, let's get it done. He said, I'm already in the car driving to his house to make sure I get him to sign it before he changes his mind. He said, this guy in 30 minutes would change his mind once he thinks about these things again. So I ended up buying that for that building, plus the land that I had a house on it. Now, to be fair, that house isn't really worth very much. It is tenanted, but it's, and you're going to laugh, Luc, right? Every time I see one of your ads, there's one ad that has a picture of a house that's a bit of a rundown house, right? And every time I look at it, I have to do a double take because it looks very much like this particular house that came with the deal. I'll have to show you a picture of it later. But I ended up getting that whole thing done. So then I proportioned the values, of course. So I ascribed out of the 850, I gave 600 to that mixed use building, and I gave 250 to the house and the land. There was nothing for me to do on that property from a redevelopment perspective, and all that I had to do was just rotate the tenants. And as I said before, I don't push tenants out, right? If they're good tenants, I leave them be. If they're problematic tenants, that's a whole different scenario. But by one means or another, the commercial tenant was easy. Replace the commercial tenant with a good Class A tenant. 4 of the residential tenants ended up rotating out. And so my business case originally I had planned over more of a 3 to 5 year term. I had done all of those changes within a year. I think it was 9 months to 12 months in that. So, and the rents were considerably higher. The market rents were in the order of $1,700, whereas the rents that I'd inherited were in the $900 range. A guy just taken his eye off the ball on the market. He didn't realize where it really was. So in that scenario, the value of the building was now, I think it was 1.7 or 1.8, something like that. So then we refinanced that, paid out the vendor take back for just the commercial portion because I'd separated those out from I separated out the title and I kept the liens separate as well. So I just paid out the one and I kept the private, the vendor take back on the house, but I paid out the residential one with an interest rate that was probably half of what I was paying, and with a 40-year amortization as well because I had CMHC insure it. And I got a lot of equity takeout on that we just rolled into future acquisitions. So, that was. Yeah.
It sounds like you didn't need to do much work to it, renovation-wise. No, so you got significantly more out on your refinance than, because what would you have refinanced that on that 1.7 or 1.8 million? What kind of loan to value would you have gotten on that from CMHC?
The interest rates were low, so I think I got I think it was 83% loan to value on that one.
And you say the interest
for whatever reason,
most loans are limited by the debt coverage ratios, right? Is that why you're?
Yeah, that's right. So I used CMHC in that, and so theoretically, their conventional product can go to 85% loan to value, but I think it was the debt service coverage ratio that limited to about 82 or 83%. So
that sounds amazing.
Yeah,
you barely had to do anything in terms of turning over units. You got essentially a free house out of it, and you got almost $500,000 extra refinance out of it. What a deal. Great job on that. Great the way you negotiated that and everything. But so tell me what you think the greatest kind of learnings from that deal was.
Oh, okay. That's a good question. Let's see if I have a good answer.
Get any, because sometimes, like we said, you learn the most from the bad deals.
No, there were a lot of good takeaways from that. One is, and you kind of alluded to it, but you didn't call it out specifically. I always get to know the seller in any deal that I do. It puts, a face to the name. You're not a faceless corporation. You're not a faceless offer. You're a real person. And I find that that makes a huge difference, especially when things get snug, right, in a negotiation. Because now they're dealing with Luc or they're dealing with Christian. They're not dealing with 1, 2, 3, 4, 5, 6 Ontario Inc. So having a relationship with the seller is important. Persistence was another piece in there, right? So my offer didn't go through the first time. The offer that did get accepted, I walked away from. I could have left that all alone. I maintained the relationship with the seller all the way through. And a lot of my good deals have been like that. I had one deal where I maintained a relationship for the seller for 5 years, right, before he finally sold to me. So, but I'd call him up on a regular basis to see, where are you at now, right? And, so those relationships matter. I think that was a key thing. I think another key takeaway in that story is that, again, coming back to the problem solving, is what matters to the seller, right? And I asked the question there. The seller was fixated on the price and not the total deal. Whereas for me, and the realtor, the agent that was involved at the time, he and I had a coffee afterwards, and he said, "I don't understand why you went to 850. You told me that it wasn't worth more than 790, 800,000." I said, well, do the math on that 6.5% to 4.5% interest cost, right? And the epiphany hit him right there, which is, I saved $60,000 right there on the VTB. So he got his price and I got my price. I got my 790, he got his 850. That's why I dropped the interest and asked him to drop it from 6 to 4.5%. So again, it's always like, what does the seller need? What's his focus? What is it that's important to him? And what things are not that important to him? And if you can structure the deal in a way to address what's important for them while protecting your interests, then that's a good win. Right. So I think that's another valuable lesson that came out of that. And maybe third is that, or fourth, I don't know how many we're at, is I mentioned I walked away from the deal at one point when I realized that my underwriting wasn't supporting what I was doing. And I was prepared, even though I'd invested time and money, I was prepared to walk away from the deal. And that was a really good call. For a lot of different reasons, not just because I ended up getting a better price in the end, but those decisions can be super hard, especially, it's not even the cash, right? Like half the time people are okay, they're uncomfortable with walking away from the cash that they've already outlaid, but you get emotionally invested, right? When you're doing a deal like this, and you get to a point where now you just want it to work out. And it takes a lot of willpower to kind of look at this objectively and say, this deal isn't right? And be prepared to take it back off the table when you can.
Yeah, absolutely. It's both an emotional and it's also the sunk cost fallacy. Some people think they've already put so much time and effort into the deal that, then I'll just pay a little more to make it work because I already put so much time into it. But yeah, I think stepping back, like you said, somebody else showed interest. Say, okay, well, let's just wait a bit because we'll see if they actually pull the trigger, right? We do that regularly because when you have to compete in the same way, you're suddenly throwing more money at them because you just want to make the deal work. It doesn't. You can do it if that's if the deal's still great, but you can't just throw money at the deal. But yeah, and I think what matters to the seller, relationship with the seller, but also what matters to the seller. I've seen that a few times where sellers care so much about the price. A friend of mine bought a building in Peterborough, and he was trying to negotiate a VTB with the seller. The seller wanted too much money. And I said, well, see if he'll take a VTB at no interest payment, 0 interest. So he negotiated, I think, like a 70% VTB, and they were principal-only payments because it was interest-free. It was with a 0% interest VTB for several years.
Yeah.
While he turned over the building. So think about how much. Yeah, sure, he paid, I think, quite a bit more than market value. But when you count what he saved on financing costs, he got a steal of a deal. But the seller feels like they were the ones winning. So it's a win-win. Everyone feels like they won for different reasons. So yeah, I think those are great lessons. And yeah, it's nice to see, because sometimes we have the successful deals that go well and just everything went smoothly. So it's harder to learn from those. But I think the way you were able to make this deal successful is, first of all, what made the deal successful, but also what gives us the learning lessons to take away and hopefully take to some of our own deals. So we're going to get into the final part. I have 3 final questions for you. First is, what has changed about your approach to real estate investing with your experience?
I continuously refine my skills. I'm learning all the time. And as I said, it's a very broad field, so you're never an expert in reality. You just get better and better at what you do. I've clearly mastered the ability to take what most people would consider to be long-term investment assets and figuring out how to make them cash flow. It's something that I am very good at. But I continuously take courses and training and seminars and conferences, and I don't mind spending tens of thousands of dollars on this stuff in order to continue learning. I'd say the stuff that I've been learning a lot about more recently, because I've been doing a ton of refis, is understanding more and more about the lending practices and where power lies, who's doing what in the industry, because it's a very opaque industry for most people. You go into it, a particular lender offers you a particular rate. You think it looks pretty good versus others, but you're not really thinking about what's going on behind the scenes. And then you eventually learn that there are constituents behind that. There are people playing specific roles within the lending community. So stuff that I've been learning much more recently is, so here's something you learn as a private lender, right? Is everybody thinks, with the bank is in control, right? I'm afraid of the bank. I got to worry about the bank. The moment you start doing private lending, you realize that once that cash is handed over, the borrower has all the power because they've got your money now, right? So you got to figure out how you're going to get back. So if you extrapolate that back to the banks, I'll give you a recent example. I'm not going to mention the bank only because I don't want to cause any issues, right? But I had 2 mid-sized residential mortgages. So these were underwritten with CMHC within this particular bank's multi-unit group. And I decided at one point that they weren't necessarily going to meet my needs. I gave them first shot at it. The underwriting they came back with I thought was far too conservative, and I was going to go shop it. So often I do shop it, but I've got a loyalty to my vendors, so I always give them a first shot at trying to keep my business before I start shopping it. And that was the case here. So I decided to start a new process with a broker that was going to be assisting me on this. And the bank said to me, so, well, your mortgage is matured, so you've got to pay it back, right? And I said, I do, right? So, one of the loans was up December 1st, another one was up January 1st, and so so the December 1st, so, well, it's due, but, we normally will give people up to 60 days. I said, yeah, I'm going to need longer. Well, you gotta renew it. We could put you in when you're open. And I said, no. And they said, what do you mean, no? I said, no. I said, I'm not going to take a 1-year term when I'm planning to refinance this over the next, 3 or 4 months. So then they said, came back and they said, look, they wheeled out this little product that they never use. So they said, well, we've got this 6-month fixed mortgage that you could do instead. And so we never use it, but we have it available. And I said, well, do I still have to worry about the yield maintenance fees if I terminate it earlier, right? i.e. it's like an interest rate differential, right? The equivalent for commercial. So they said, yeah, it still applies. And okay, no, I'm not interested. Right. And they said, well, what do you mean you're not interested? You got to pay this out. And I said, I said, I just need a bit more time. And, and honestly, what are you going to do? Right. So are you going to take control of my properties every forward? You don't want to do that. I don't want to do that. I said, I've been a good customer. I'm doing other mortgages with you guys, etc. I just need more time. So they said, okay. We'll give you to April 1st, but that's the absolute deadline. So I said, okay, that might actually work for me. So I managed to close those refis literally on March 31st. And so I met my commitments to them. Now you might say, okay, well, the lender is not going to be really happy about lending you any more money in that type of scenario, right? They closed 3 other mortgages with me in the pure commercial side, non-residential, and they expanded my lines of credit at the same time while I was in that type of discussion. So it didn't even
want their money back. Yeah.
They want their money back, and they didn't mind learning. They weren't going to, as the saying goes, to cut off your nose to spite your face, right? They weren't going to do that. They wanted the rest of my business as well. And I said, well, as one of the concessions out of this, I said, I don't need to do this, but once, because I ran the certificate of insurance with CMHC before going to the lenders. So once I had the certificate, then I went and I shopped it back to that particular bank. And I said, can you meet this? Right? I said, I'm going to give you a shot at it. And they couldn't even come close, unfortunately. So I went with a different lender in that case. But, there was a lot more that I learned through that entire process in terms of the underwriting process that happens behind the scenes, which could be a whole other episode, Luc. But that was one small takeaway out of that whole thing that I was learning there and continue to learn.
So what's one piece of advice that you would have for your younger self? Let's say when you were starting your tech career, what's a piece of advice now that you'd have, given everything you've seen since?
Yeah. It's always a tough question because my abilities now are largely based on my learned experience through my primary career. So, I don't want to dismiss the value that had. I do think, though, and everybody says, well, you should start younger. And yeah, you know what? There's truth to that. I would have probably learned similar types of things along the way. I probably just would have been the school of harder knocks than the way I did it. But I really believe that people should follow their passions. It's not always about the money. You need money, sure, to live your lifestyle, etc. I went into real estate to backstop my retirement. I thought it'd be a good investment. I wasn't really passionate about it at the time. I was very passionate about my tech career, and I had a lot of fun doing that. When I started to get serious about the real estate piece of it, it became a passion. It became part of our life. I enjoy it. I love what I do, right? So the fact that we make money is a byproduct of that passion. It's not the motivation for me. Right. So, and I'm sure this is similar for you. I don't need to do this anymore. Right. I'm established. We've got enough net worth that, quite frankly, I could just let it ride and live off the cash flows of the business and not continue to grow. But it's a passion. I really enjoy it. And so if you don't enjoy it, it's going to be hard work. And there are some very trying times in real estate. So, yeah, I'd say, at the end of the day, it rolls back to follow your passions. If you do what you're passionate about, right, then and you have enough money coming out of whatever that passion is, then you're probably in good shape and have a happy life.
Yeah, that makes sense. I mean, I hear often real estate investors, some like to say, "Oh, I don't particularly like real estate. I just do it because I think it's a good way to get returns." I personally think part of the reason for my success is that I actually really enjoy real estate. I like it. It excites me. It always has my whole life. So, yeah. Last question. What is the most overlooked or the most overhyped investing strategy right now?
Oh boy, that's one of my faves these days, actually. So that's a great question for me right now. Earlier in the discussion, we talked about the fact that I went to light industrial. Why? Because it cash flowed really well, and I needed cash flow as a primary input in my business, so I gravitated to that. One has to think about the priorities of your business and what is it that you need right now. Once you've got your basic cash flow, you can start to take a look at other investment classes. What I'm seeing right now is there's an overemphasis in multifamily investing. Everybody thinks this is the greatest thing since sliced bread now. And of course, you and I have been investing in this for quite a while. So we know it is a very good asset class, but when everybody's chasing it, right, it's no longer the ideal asset class. The returns are thinner, et cetera. There's just too much competition in there. And the other thing that I've found is that these things kind of shift and change all the time. So one class becomes extremely popular. You need to take a look at other asset classes to see whether or not there are better returns there because people are not focusing on it. Same with markets. A lot of people were headed to New Brunswick, for example. And that's not an asset class, it's a market, but it's like, why are you going there? Right? Well, everybody seems to be going there. Well, that's the wrong answer. Like, don't go there because everybody else is going there, because maybe the people before you just made a lot of bad decisions. So
if you thought everyone was going to go there and had valid reasons for that, that could be a good thing. But everyone else is already going there. Not so great.
Yeah. Well, that's right. So it's now turning things a bit upside down. And, when I take a look at a business case, you have to look at the net present value of the future cash flows. Okay. So all the people who have a decent accounting or finance background knew exactly what I just said, right? Everybody else are going like, what does that mean? And you have to take a look at whether or not a particular asset is going to generate enough cash to recover all of the input costs that you had, plus make a profit. That's kind of why I focus on things like an internal rate of return or net present value calculations on things. So when you're looking at an asset class, let's say in a mining town, right? And a mining has a finite end. Eventually, you just run out of the resources. And if that town doesn't have any other basis for its economy, it then becomes a ghost town. So you have to think about, okay, well, how long do I think that's going to go on? How much profit do I have to make? And that you have to count all that up and see if it offsets your original investment plus a decent return on a year-over-year basis. And of course, you have to adjust it for inflation. So because the value of money right now, the same dollar is going to be worth less, 5 minutes from now. So you have to take that into account. So it's more that when we take a look at a market, people often say, I'm going there because the costs are cheap. Well, there's a reason the costs are cheap, and you have to think through what that future value really looks like, and that's got to be part of your business case. So asset classes and markets, people tend to get over-focused on certain things. Right now, I'm finding that mixed use buildings. I like mixed use on main streets right now. And now everybody's going to say, okay, we better go focus on that, right? But the reason I like it is because it has, if you get the ratios right and you fall within the CMHC parameters for it, you get the benefits of being able to do a CMHC insured loan. But it has a commercial component and typically ends up with a higher cap rate than if it was a pure multi-residential building. But you've got the ballast and the CMHC benefits that you don't have in a pure commercial building. So that's why I've tended to gravitate to those right now. They're interesting to me. 6 months from now or a year from now, it can be a completely different asset class. If everybody starts focusing on that, they'll start to get distracted with it, and I'll go find something else.
I don't think everyone's going to focus on that. I think that's a slightly more complicated asset class. There are more, like you were saying, making sure you meet I actually bought my first mixed use recently, and it's half, so it does not meet the CMHC guidelines. So I am paying a higher interest rate for it. Of course, the property made sense, the numbers make sense, but it can be harder to finance these. And also a lot of these can be much older. So there's a different kind of skill set in dealing with both renovating and maintaining older buildings. So yeah, I don't know. I don't know that people, even if they want to, it's not as easy to gravitate towards mixed use as some of the other asset classes could be.
That's true. I mean, everything you said is spot on, right? But for all of these things, it's just education, right? So yes, the underwriting is harder, the lending practices. I mean, you need to know a lot of bits and pieces in order to really pull it together. I'm so used to commercial and residential that it doesn't really faze me at all. But I kind of like the fact that I don't have as much competition in the mixed use space, because it's for people who dabble or, deal primarily in the pure commercial or the pure residential, there's a foreign component to either of those classic investors. That's a, lack of awareness. Since I have both asset classes, for me, mixed use is just pretty straightforward in my books.
Okay. Amazing. Christian, if people want to find out more about you or get in touch with you, how can they do that?
So I'm very present on social media. I kind of like giving back to the community. We're not looking for investors. I'm not doing this podcast because I'm trying to find people to park money or anything along that lines. The best way to reach me is either through my website, aliferous.ca, right? And I'm sure that'll be in the show notes, or through social media. I'm very present on Facebook and LinkedIn, and to some degree on Instagram. My name is rather unique, so it's not too hard to figure out once you know how to spell it. It's quite searchable. So those are probably the best ways. And, I'll put a little shout out for the Ottawa Real Estate Investors Organization as well. It's a not-for-profit club. I'm one of the board members on that. None of us are compensated. It's purely for club members to educate and network.
I'm a member at
each other.
It's well run.
Yeah, that's right. Yeah, thank you. We're a great club, and we meet the second Wednesday of every month. All are welcome, even if you're not in Ottawa. The recordings are available of nearly all of our meetings, and when you're in town, just come join us.
Yeah, and a very, very reasonable fee because, like you said, you are not for profit. The cost to attend is minimal for the membership, so that's excellent. Is there anything you'd like to offer our audience, or that our audience could do for you?
Not for me per se. I think what's important is people really need to take the time to get educated on various aspects of real estate. I think you need to do due diligence on the education companies that are there. Make sure that you're going to ones that are truly credible, not just good marketers. And same with coaches, right? There's a lot of fly-by-night coaches out there. So make sure you do due diligence around the coaches. Make sure that, in fact, this is their business and that their primary income isn't for coaching. I do offer a lot of free stuff on my website for people because it's just part of my giving back. Whenever I write articles, etc., I put them on my website. They're usually instructional and informative. And there are resources there for landlords, resources for tenants. People are free. Just respect my brand. That's all. But other than that, my marks. But other than that, people are free to use any of the resources that I have there for their own business or for their own learning benefit.
And I know you don't broadcast this much, but you do offer coaching for occasional select individuals. Is that correct?
Very limited. It's not my main business. My main business is investing, but a few years ago, I realized just how seedy an industry it was, and I just wanted to be part of the solution. So I'll take on maybe 4 or 5 people at a time, and that's about it. So it's very select. I don't market it, I appreciate you bringing that up, but it's not something that I run my business on. So, but I'm usually looking for people who already have had some investment experience. It's more about portfolio tuning or making sure that their fundamentals are in good shape.
Okay, excellent. Okay, Christian, thank you so much for joining me on the first episode of the Self-Wealth Podcast. I really enjoyed having your educated approach to real estate and your sophisticated approach to real estate, and you sharing that with our audience and all the information you share with everybody else. So thank you so much for coming on. And to everybody else, we'll see you on the next episode.